It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome. This is the show you've been waiting for all week. I know you're waiting to say to yourselves, oh, thank God Aunt Jill's here. Can you kind of take a breather? First of all, it's the weekend, so there's no trading going on. That's good news. It was a turbulent week. And here at the Jill on Money show, we try to take the mystery out of your finances. We try to calm your very raw nerves. We try to walk you through what you need to know to get through what the week ahead could be. We're broadcasting from the Capital One studios. Capital One, what's in your wallet? We've heard so much from many of you, hundreds, if not thousands of emails over the last 2 to 3 weeks as these volatile coronavirus markets roil all of us. Monday, stock market plunge, biggest point decline ever for the Dow Jones Industrial Average. We had a trading halt for all of the U.S. markets early Monday morning. We had volatile days back and forth. It's crazy. In fact, by the way, when you look at these day-to-day swings, we haven't had these kinds of crazy volatile days since back in the financial crisis. So no wonder you're feeling nutty. No wonder. Okay, so let's start this show with a little bit of Aunt Jill's boot camp for how to survive volatile markets. Number one, remind yourself why you're investing. Most of us, I would say the vast majority of you guys listening, we're saving for a long-term goal. That could be retirement. It could be college. It could be maybe even a second home. But when you're a long-term investor, you're mostly talking about years and often decades in the future. So this is an incredibly important thing to remember. It can calm your nerves very quickly. Also, you want to be thankful that you're probably a diversified investor. You've got money in the stock market because you know what? You kind of need the stock market. You need money to grow faster than inflation. You need there to be some engine of growth. And that diversified portfolio, though, my guess for most of you does not mean you own large cap stocks and small cap stocks. You've got some money in the stock market, some money in the bond market, some money in cash. Maybe you've got some commodities. You got a little bit of everything. So one of the things that's important is that when you look at your headlines the day after or during a market dive, your portfolio is probably performing a lot better than that. By the way, for those of you who are still investing, meaning you're still in your accumulation phase, you're putting money away, well, this is good news. Who doesn't want something on sale? You are essentially buying stocks 10, 15, 20% cheaper than they were just a month ago. That's good, right? Oh, this is the only time when people really don't like a bargain, Mark, I'll tell you. Maybe one way to make yourself feel better about your losses in the market, even if they are temporary, is to now hone in on your investment fees. Maybe you can say to yourself, well, that extra 1% in the management fee is something that I'd like to keep for myself. These fees that we pay, the costs of investing, they tend to pile up, and you don't notice it so much in a year like last year when the markets were going great guns. This year, I bet you'd like that 1% back. So maybe you want to replace an actively managed mutual fund with a no-commission index fund. Maybe you are paying someone who's calling him or herself an advisor who really isn't doing much. Maybe you want to go to an automatic trading platform. And that, to me, is something that I like to say, find the money, the free money. Now, there's a caveat around all this long-term investing, and that is, if you need the money sometime within the next 12 months, maybe it's a house down payment, maybe you're going to buy a car, maybe you're going to pay a tuition bill, anything you need within the next 12 months, remember that money never should have been at risk at all. Time to bite the bullet, admit you blew it, sell it, and keep it in a safe savings, checking, or money market account. And as always, we like to remind you that if you're looking for some of those safe, best yielding, safer accounts, hop onto depositaccounts.com. All right. Now, we also didn't we get a slug of emails, Mark, from people who are like, I'm retiring soon. What should I do? Right? Okay. Again, deep, calming breath. Because remember, you don't need all the money from your retirement account the day you retire, right? In fact, if you're thinking about retiring, you're in your 60s, you'll take maybe a little bit out at a time, but you need your money to last you throughout your retirement. You're going to live 25, 30 years. And I think what's really important is to consider that you actually, as a retiree or near retiree, you still need to have some money in the stock market. We've got to have you grow your portfolio faster than the pace of inflation. Okay? So that's a biggie. All right, now let's get to something really great. Let's presume you've got some cash that's on the sidelines. How about that? If you got some cash on the sidelines, get going. I'll tell you what I did. I had to make my own retirement contribution for last tax year. I had to do that. And so I did it on Monday. I'm not really trying to time the market. I knew I had to get the money to work, right? I have to make my retirement contribution. I just did it on Monday. And if the market goes down another 25% from here, I don't care. I just had to do it. Imagine this. If you're getting a tax refund, or maybe you're funding that IRA or Roth IRA, hey, get going. Put that money in right now. I think that's a great idea. For those of you who are maybe smaller investors, you're just starting out, maybe your kids are looking at investing, as a reminder, amid all this volatility, it's really never been a better time to be a small investor. And the reason why is that almost every brokerage firm has lowered the minimum amounts necessary to invest. They've waived commissions. They now offer low-cost index funds at a fraction of the cost of what they used to be. This is incredibly important. So I think that price war that's happening among all the big brokerage firms, great, good for you. Last but not least, as fear has increased, what has also happened is people are piling into treasuries. And when money pours into treasuries, the prices rise and the yields, which move in the opposite direction, go down. And when you look at mortgage rates right now, because they usually key off the 10-year treasury, they're near all-time lows. The average 30-year fixed-rate mortgage, most people, for a conventional, not a jumbo, we're talking about 3.25%, 3.5%. Come on. We're talking about the lowest level for mortgages in nearly 50 years. So what should you do? Go out, run the numbers, talk to a mortgage broker, try to reduce the cost of your home loans, and get busy. All right, that's it. That's your Panic Prevention Aunt Jill boot camp. When we return, we're going to talk to you, field your questions, and figure out what you need to do to stay on track to reach your financial goals. It's Jill on Money, and we will be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You are back. It's Jill on Money. I know it was a rough week. A lot of volatility. Get used to it, kids. This is going to be with us for a little bit. Sorry about that. It's part of being an investor. And it is tough. It's tough to stomach the ups and the downs. If you need some help, just hop onto our website, JillOnMoney.com. I did a ton of segments for CBS This Morning, for CBS Evening News this week. I've written a lot about this. We have a great post about what you should be doing now, some of the things you can take advantage of, by the way. Bond yields dropping to all-time lows. In my lifetime, I have never thought that we would ever see the U.S. Treasury yield drop below 0.5 percentage point. on Monday morning early when markets were getting hammered, that's what happened. All right, let's get to our caller. It is Tara, who's on the line from Pennsylvania. Tell me what's going on. What can I do for you?
Okay, so I have like all this money, and I honestly think once I retire, we'll have plenty of money to get through our retirement between Social Security and the money we have in the bank. So I'm not overly worried about that by the time I actually do retire. But I'm worried about some kind of super big market drop, and I am hoping to work another, 3 years, 4 years, whatever, assuming the job lasts. And my husband is retired, so he's not going to take Social Security until I do retire.
Yeah.
But I'm concerned about this market, and I'm thinking I should just put some money someplace where it's just going to earn a little bit and it'll be safe.
Okay.
What are your thoughts?
So you are how old?
I am 60.
And husband retired is how old?
65.
Okay, got it. And how much do you earn right now?
140.
Okay. And on that 140 alone, like that one salary, you guys are fine?
Yes.
Okay.
We live on it. I fully fund my 401k. I fund both our Roth IRAs, and we have no debt.
Wow. Awesome.
I know,
how much money is in the 401k right now?
So in the Fidelity one, we have about $1 million.
Mm-hmm.
And then in other ones, between the two of us, we have about another $500,000 or $600,000.
Other 401ks, or are you talking about the Roths there?
Not Roths and traditional, some rollovers. And,
okay. All right.
Yeah.
So 500 to 600. So 1.6 million is what we got, right?
Yes.
Okay, got it. When you retire, will you be entitled to any pension?
$450 a month.
Okay. And what does your Social Security for both of you look like? Let's presume like it is like, for you, it would be your full retirement age, and for him, it would be 70, let's say.
So his will be at 70, will be right around 28 or 29. At mine, at full retirement range age would also be about 29.
Okay, $2,900 a month, right? Is that
right.
what you're telling me? Okay,
yep,
good.
Each.
Okay, now I know that you're living on your 140 right now, but what is the amount that you need? That if you look ahead, like what do you really think you're going to need going forward?
Well, I actually did a spreadsheet on that.
Of course you did.
Of course I did. And I think we are comfortable, like with a few trips and putting a new roof on periodically and all that kind of stuff, probably right around $60,000.
Great.
I know.
That's really good. So, okay. And it looks to me like you're going to have income of about $75,000. So that's good. Right. So you don't really need to tap these accounts anytime soon. So, all right. Let's hope that you live for, we're talking about really not investing for tomorrow, but we're talking about 25 or 30 years, right?
Right.
I want you to have a nice long retirement. How is the money allocated right now? If you look at the, all of these retirement accounts, about how much in stocks versus bonds versus cash or commodities, what's your allocation?
They're all around 60-40 now, 60 stock.
Okay. All right.
And I have a bunch of them in, like as I rolled over stuff in target funds, which right now are probably 60-40 as well.
Be careful about those, though, because I think those target funds tend to have more risk in them than many people realize. So I would just caution you about that. Okay.
Interesting. Okay.
And it's not all of them. I mean, but each fund family manages target date funds slightly differently. And I know this from myself, because if I look at my target date fund of like the 2035 fund, it will show me a higher level of risk than I would be comfortable with, because I'm a wimp. I'm like you.
Right,
I'm
me
a wimp.
too.
Okay. Now, because you're a wimp, I'm going to tell you that you have an easy fix. You don't have to figure out when to sell and time the market, because that just doesn't work. But what you could do is simply flip your allocation. Instead of being 60-40 stock to bond, just do it the other way and be 60% bond, 40% stock. And relax. Calm down.
I like that. Okay, I'm a little concerned about the bond thing these days as well.
Why?
Because
Don't be worried.
Because they're not, they're
Okay,
they're
let's say
not
you're
that
really
I need them to do well, but I'm
what we really want to do is we want to create an allocation that is going to prevent you from feeling like you have to panic if the market dumps. That's really what your goal is. Because
Right.
I could tell you statistically for 30 years, a 60-40 portfolio is going to be fine. Okay? It really is. But I am more like you. Okay? I don't like the extra risk. I even understand it. I can do a calculation to show myself that I would be better taking on more risk in my portfolio personally. I don't do it because I am very happy sleeping at night. And you can sleep at night beautifully if you are willing to say, I don't care if I make as much on the upside because I don't want to lose as much on the downside. And with a 60% bond and 40% stock, or even if I just, let me put it this way, 40% stock, you could go 25% bond and 15% in, treasuries or long-term, or a high-yielding money market, whatever. You don't care because you have plenty of money. You're going to have the income you need. All you want to make sure is that you have almost like a disaster-proof portfolio. And
Right.
that's what you would have. So I would suggest that instead of trying to figure out wholesale moving in or out of the market, because it doesn't work. It really doesn't work. And here's why. Because you'll sell all of your stock positions, and number one, you don't know where to put it. Number two, interest rates are too low. There's a reason why there's an acronym TINA. There is no alternative because bonds, you're right, bonds are not paying very good interest, and the ones that are really risky, so I wouldn't suggest those. A plain vanilla portfolio for you could be 40% in stocks and then, maybe 30-40% in bonds and then some cash. And relax and don't worry about it. And you'll be
Awesome.
fine. And you don't have to really, in your case, what's really fantastic is this is not taxable to you. You can make these changes wholesale and not worry. When you're looking at your current 401k, don't forget, if you make changes for the current assets that are in there and new money that's driving into the 401k account, okay?
Got it.
All right.
So most of the money is at Fidelity and Vanguard.
Great.
Can I just use the big bond funds there and call it a day?
You betcha. There's there's usually an intermediate term bond fund. Both Vanguard and Fidelity have those. There is an extended stock market index in each of them. You can use those.
Got it.
All right.
All right, I'm writing that down. Awesome. You rock. Awesome. Thank you so much for the call. I really appreciate it.
Thank you so much for calling and wish you the best of luck. So give us a holler back if you run into any problems, okay?
Oh, you're great. Thank you.
Take care. Bye-bye. We'll be back in just a second with more of your questions. If you want to learn more about some of the stuff going on, you want some bite-sized nuggets, how about subscribing to our podcast? It's called Jill on Money. And you can get it anywhere you find your favorite podcast. Maybe that's Apple or Stitcher or radio.com or Google Play. Or just go to our website, jillonmoney.com. Subscribe to the podcast. Sometimes it's nice to get a little feed every day. It's cool. All right, we'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money. And now it is getting on in tax season, ladies and gentlemen. So get moving, get cracking. You'll feel so much more virtuous for having done your taxes, I promise. If you do have a question as you're completing forms, or you're plodding through, or you got a refund, or whatever came up after tax season or during, why don't you give us a shout? Ask Jill at jillonmoney.com. Ask Jill at jillonmoney.com. Okay, Doug writes that he turned 70 and a half last year in 2019. When do I need to start taking funds from my 401k? I heard that I can now wait until I'm after 72. Can you please clarify? Confused in Denver. I didn't know the answer to this question when you first asked this. I thought I did, and then Mark helped me. He looked it up on a friend of the pod, Michael Kitzis's website. And Michael Kitsis is a complete brainiac when it comes to financial planning. And he's got a website called Nerd's Eye View. And Mark looked it up, and it seems that you are operating under the old rules. So if you turned 70 and a half in 2019, yes, it's the old rules that apply. If, however, you've turned 70 and a half in 2020, the new Secure Act rules would apply to you, and that means you can delay taking your required minimum distributions until you are 72. So sorry about that, Doug. I bet you wanted a different answer, but that's the one we got for you. Carol writes, I'm a spendthrift. I have an inherited IRA of about $90,000. It's my only savings. At age 67, I take Social Security. It's $1,000 a month. I work part-time for lots of friends, under the table, about $500 a month. My rent is $1,000 a month. My gas to the work I do costs about $400 a month. I have Medicare. I don't see doctors very often. I need to invest the money in the IRA because I need to make withdrawals, the required minimum distributions, plus money to enhance my income. My thought is index funds. The advisor on the account, which came with the inheritance, suggested their managed funds. I assume fees would be higher. What's your take? Carol, I like that you sort of like take the bat out of my hands so I don't have it. At least you know yourself. So here's the thing. No, you don't need to keep the money in any sort of feed account because, in fact, you don't have that much money. So here's what I would do. You got 90 grand. I would move that 90 grand, that inherited IRA, to a robo-advisor, meaning an automatic investment platform. There's lots of them out there. There's Betterment. There's Wealthfront. There's Vanguard Personal Service Advisor. It's probably the one I would check out. Or Schwab Intelligent Portfolio. I think basically Vanguard or Schwab I would check out because it will be a very cheap way for you to invest. And then you may even get a little bit of advice. And that might be something that's helpful for you because especially if you're the kind of person who might be inclined to touch the money. So check those out. All right? All right. Claudia writes that she listens to the show on Cairo in Seattle. Oh, thanks so much. Love Cairo. Okay. Here's the question. Claudia is still working, and she's 66 and a half. She says, I expect to sell my company to a longtime employee at the end of 2023 when I will be 70 and a half. My husband is 74. He retired 4 years ago at age 70. His Social Security benefits in 2020 are about $3,700 a month. Since I was born prior to 1954, is it true that I could file for spousal benefits of 50% of my husband's benefits now and then file for my own benefits, which would estimated to be about $3,200 in 4 years? Is there any reason that I should not do this and use the money to boost my retirement savings? If I'm researching correctly, it looks like I'm lucky to hit a sweet spot with my birth date. Well, baby, if that sweet spot is there, jump into it and take it. I love this idea. You probably will be able to double check simply by trying this on the Social Security website, because if you can't do it, then you will find out quickly. And then there's just one extra question here. Is there an advantage of increasing my $120,000 of annual income from my business in the next 4 years to build a higher average income for Social Security calculations? In the past, I've tried to minimize my income to reduce taxes and the higher cost for Medicare, but maybe that wasn't the smartest approach. So, all right. So here's what you got to know, gang. The upside and downside is it's probably not going to make a huge difference at this point because you are certainly, paying Social Security on the 120 that you're pulling right now. The Social Security wage base this year is 137.7. Okay. So you could, I mean, if you raise that amount to 130, if you raised your salary to 137.7, it will cause you to pay more taxes, but you will get a higher benefit. There's probably some math to be done. I can't do it like on the fly right here, but I don't think it's going to make a big difference either way. I really don't. So I wouldn't go crazy with it. But do, for sure, take advantage of that sweet spot because that seems like a kind of a no-brainer. Okay? Here's a question from Tim. He's horrible with money. He says that. He's 56 years old. He's got $47,000 of income, and he's got just a ton of credit card debt, and he's in trouble. And he says, should I file for bankruptcy? You know what, Tim? Here's what I would do. Meet with a lawyer and find out, because I don't want to give legal advice on the air because who knows, but at the very least, talk to a lawyer and understand what the upside and downside of doing this would be. All right? Does that make sense? It's a very big decision. I get that. Okay? You're listening to Jill on Money. And when we return, we will get back to your questions. If you have a financial question, we'd like to hear from you. All you have to do is send an email. Ask Jill at jillonmoney.com. Okay, we'll be right back.
401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's Jill on Money. And we are here to take the mystery out of your financial life. So therefore, if you've got some mysteries, tell us about them. If you're on the website, jillonmoney.com, where you are reading or listening to old shows or watching TV segments or plowing through our resource section, all you have to do is click on the contact button. Isn't that easy? And you can contact us. Let us know what's going on. Here is what Timothy wrote. I was running an errand on a Saturday afternoon and came across your show for the first time, and I really enjoy your perspective and demeanor. See, Mark, he likes my demeanor. Mark just raised his eyebrows and rolled his eyes at the exact same time because my demeanor today maybe not be as nice as I am on the air. Yeah. Oh, yeah. He's threatening to call the spouse. Okay, here's what's going on for Timothy. I put my savings into mutual funds, and my advisor recently told me we should diversify. Currently, the majority of the money is in an overseas fund. I was saving money to buy a house someday, but I was priced out where I live in Seattle. I put what I had into a money market account, which was $25,000. A year later, a coworker whom I trusted also worked part-time for Edward Jones and convinced me to invest in mutual funds. This was right after Obama was elected in 2008. It's since done great and doubled in 10 years. I was about to take money out to pay for credit and dental bills and took out a small loan with Edward Jones against the funds, was able to help my wife open a salon. Her income has tripled, and we paid back the loan. Whew, they took a margin loan. Holy smokes. Got lucky on that. My question is, the stock market at highs, the election is coming up. Is it wise to sell the funds and hold out until after the election when the Dow lowers a bit? 1 minute on that. Let me get back to his story. I'm 44, a first-generation immigrant with a green card. I left school after the 7th grade and became part of the labor force. I just enrolled in college, the first in my family to do so. How awesome. He's studying to be a paralegal. Is it a good idea to reinvest when the market is so high? Maybe we should sell it all, hold on the money. I bought when the Dow was at around 12,000. Now it's at 29,000. Is there a type of fund I can transfer until the market cools? Blah, 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 blah. Any advice? Okay, Timothy, here's the deal. Calm down. What you're talking about is market timing, and no, you shouldn't sell it unless there was some particular reason that you would need this money. There's no, you can't try to time the market. You don't know if it's going to go down. What if it keeps going up? Who knows? But here's what I would say. If all of this money is in the market, maybe what you should do is take some of the money out and pay off any debt that's outstanding. Maybe you should take some money out and be sure that you have an emergency reserve fund. Or maybe you should take some of the money out and fund a retirement account. But going to cash right now, I think, is pretty dangerous. You could put some of the money that is in the mutual funds. You could put some of that in a money market just so you have it available. But gosh, I would feel so awful if you completely got out of the market and then afterwards the market just kept going higher. And if you don't need the money for any particular reason, diversifying does make sense, but just be careful. Be careful, okay? All right, here's a message from Greg, who has a 403B plan at work, but he cannot afford to max out the contribution. He puts in 6% of his pay, and the employer matches 3%. And it's been going into a Roth 403B. I recently inherited some cash. Should I start my own IRA to reduce my $2,700 federal tax owed, or should I use the catch-up opportunity through my employer and just pay the tax? How much can I contribute to an IRA? I'm 63 and I have $500,000 in my retirement account. You can't go back and do the 403B. If you have the cash to pay the $2,700 federal tax, just pay it. I don't even know if you need to do the IRA. Why don't you pay the tax and just adjust your withholding a little bit, maybe just one extra, and maybe don't do anything else. Maybe that's it. Because otherwise, I don't know if you need to do the IRA right now. Sort of like starting a whole thing all over again. You didn't say how much you made, but I don't know. I'm thinking that maybe stand down, and I think that probably makes more sense. The cash, I think you put into a general investment account or make sure that you have an emergency reserve fund, but I don't know if I want you to tie it up in an IRA right now. So that's what I would say. How's that sound? That's pretty darn good. All right. Okay. Here's one from Chuck, who works in retail. This is a long message. You know what? This is what we're going to do. I'm going to get to Chuck's email in a second, so I won't do that. So I need a few more minutes to get that. We'll do that. We'll say that for our last segment. Okay, you're listening to Jill on Money. If you've got a financial question, we'd love to hear from you. Ask Jill at jillonmoney.com. Don't forget to follow us on social media. I've been forgetting to say that myself. Twitter, Instagram, Facebook, YouTube. The handle is at Jill on Money, and we will be right back. You're back. It's Jill on Money. We're broadcasting from the Capital One studios. Capital One, what's in your wallet? All right, this email is basically a consolidation of every single email we've received in the last few weeks. So this is from Barbara. She says it kind of very easily and bluntly. Hi, Jill. My question is regarding the plunging market and investment potential. I am considering putting money into mutual funds, right? So this is kind of great because we have two types of emails that we've gotten from you guys. One is I'm scared what should I do? And the other is, what can I do to actually profit from this period of time? Okay, so Barbara says, here's my reason for investing. A virus, by definition, is self-limiting. It will end, at least for this year. 2, the news reports the number of deaths, but not the number of infected who have not died, which, if I'm correct, is a very small percentage. True, we just haven't tested enough. 3, the flu at this point still kills more people annually than have died from coronavirus. I don't know, that never makes me feel better, FYI. 4, even if production slows down considerably, people will recover. They'll go back to work within weeks, probably months. Okay, I realize it's still a risk, but is my thinking outright crazy? Am I missing something? Is this an opportunity? I haven't heard anybody speak of an investment opportunity. I'm thinking of waiting until I see a slight rise and then moving the money. Not a huge amount that would jeopardize my savings. Any advice is appreciated. I listen to your show regularly on WTIC. I hear you on Monday mornings with Ray. Okay, I love this question. Barbara, let's not talk about timing the market. As I said at the top of the show, the reality is that no matter what, you're buying the stock market cheaper than you would have just a month and a half ago. I wouldn't do something nutty like someone asked me this week, should I take more money out of my refi in order to put it into the stock market? That I would not do. But go ahead. Don't have to wait for anything. Just pull the trigger, make your decision, move your money, stick to your game plan, and try not to mess with your plan once you've set it in motion. It's Jill on Money. When we return, we are going to have a guest, and we're going to take more of your questions. If you are wondering what to do during a market meltdown, just go to our website, jillonmoney.com. Click on the Read tab. You'll see all the stuff that we've done. Also, check out all the stuff that we did during the week on TV. Okay, Jill on Money. We'll be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome back. It's hour number 2 of Jill on Money, and we are broadcasting from the Policy Genius Studios. Policy Genius is the easy way to compare and buy insurance. Just go to policygenius.com. Today, we've got a real treat. We've got Joel Peterson. He's the chairman of JetBlue Airways. He came in to talk about his book that's called The 10 Laws of Trust. Now, I just want to make a note that he was here in the studio recording this before all of the craziness around coronavirus and the impact on the airline industry. So you will notice that we do not talk about that. I don't want you to be disappointed, but just remember that this was taped a little bit while back, so we need to make sure you know that. That said, he's a really interesting guy. He's an academic. He's a private equity investor. He is a corporate titan. He is a font of information. So here is our interview with Joel Peterson. So what was your first job when you graduated from Harvard?
So I joined Trammell Crow, who was a big real estate developer. He had 163 people working for him at the time, but he posted a little 3x5 card on the placement board. He wasn't even interviewing at Harvard, but he had this little card on. He said, needs somebody to go to the French Riviera to develop buildings. And that's what I did. I raised my hand. And I thought, I don't know anything about real estate. I don't know anything about Trammell Crow, but my high school buddies will never believe that I ended up on the French Riviera.
And where on the French Riviera were you?
So I went to Aix-en-Provence.
Lovely.
In the beginning. And then it ended up that I was in Paris for a year and Lyon for
Poor
a year.
you.
I know.
Do you
tough.
speak French?
Yes.
Really?
Yeah.
Did you have to speak French before that, or did you learn while you were there?
Well, I spoke it before, and then I learned more when I was there.
Were you single or married at that time?
Married.
And so she came along.
She came, absolutely.
And you didn't have kids?
We were supposed to be moving to France, and it took forever to get the papers through. So we had a daughter that was born in Texas. Then we moved with her when she was an infant to Paris. then moved to Lyon and had a child in Lyon. A
Wow.
little French girl.
Wow. And so you spent this time working for Trammell Crow. What are you doing? What's your actual job?
So I'm leasing and building buildings and actually financing them and kind of being a real estate developer.
And then how long did that last that you were in France and then you come back to the States?
So it only lasted about 2 years. And then the company got in trouble. And I ended up coming back to the United States to be the treasurer of a company that had no cash.
Oh.
And if you know what treasurers do, they manage cash. So our CFO left, and about 6 months later, I became the CFO of what became the largest private developer in the world.
Wow. And how long were you doing that?
So I did that for about 10 years.
Why did you leave? It sounds like this was a great time and you were making a bunch of money and the company's doing well. Why did you leave?
Well, so the late 80s, there was another meltdown. Real estate is very cyclical. Gets overbuilt, overleveraged. So by the late 80s, maybe 88, 89, there was kind of a crisis in real estate again. I was asked to come back in. I'd actually moved to California and had decided to do something else. I'd done well, and I just wanted a next career. And the partners asked me if I would come back and be the managing partner. So for 3 years, I commuted from the West Coast to Dallas and worked on that. Then finally, I decided I need to do something else.
And what was the next thing?
So the next thing was I started buying companies. And,
Just for fun?
Yeah.
Because you could do that.
And then I realized I actually know how to work with entrepreneurs and help them be more disciplined and actually build great companies. And somebody said to me one day, "Hey, you're in the private equity business." And I said, "What's that?" I had no idea what it was. I thought I was just buying companies.
Yeah, I'm just buying companies. We got a name for that. That's great. When you go through that experience, what are you noticing? This is probably, the 90s?
This is the early to mid-90s, yeah.
So what are you noticing that has changed in these companies as time has progressed? Because you work with the Trammell Crow, you see a small company turn into a big one. Is there a different mindset in the 90s that you encounter?
So I found for much of this that it was the same kind of thing, except the thing that surprised me the most was how smart and capable these managers were. I think as developers, you tend to be kind of very entrepreneurial, very self-confident, swashbuckling. You make your own decisions, you carve your own way. And so developers have a certain ego, the way they go about their business. And so I think I probably absorbed some of that, therefore dismissed a little bit people who were corporate executives. And I found that they were really brilliant, capable, hardworking, honest. So I really liked working with them. But I found that they could also use some entrepreneurial nudging.
Some guidance.
Some guidance.
Now, do you think the guidance came in the form of managerial guidance or strategy guidance? What could you add that they didn't have?
A lot of it was just a listening ear. It was allowing them to say what it was that they were interested in doing and reflecting, trying to add wisdom, asking questions they might not have asked. It's a lonely place at the top of it's lonely being an entrepreneur, being a founder. It's lonely being a CEO. And a lot of them don't have people that they can really bounce ideas off of who will ask good questions. And so I found that a lot of what I did for developers, I could do for founders, entrepreneurs.
Basically, you're a shrink.
It's kind of what I do.
Right?
You know.
Okay. So now you buy a bunch of companies, take me into the 90s. What's going on next?
I was on the board of the advisory board for the Graduate School of Business at Stanford. And the guy who was teaching the real estate finance course left. And so they said, would you fill in for just a year? It won't, and real estate, it won't take much time.
Right, no big deal.
No big deal. Just fill in for this course. Well, I ended up for a course that met 2 or 3 hours a week in 2 or 3 sessions. I ended up spending 40 plus hours a week preparing, grading papers, everything. And I found it was really hard and compelling. And I liked it. So 27 years later, I'm still doing it.
That's fantastic. Yeah. All right, let's talk about your book. You wrote The 10 Laws of Trust. Why is trust the theme of this book? What is it about trust that you think is so important to discuss in corporate America?
Well, I think it's the most important currency a leader has. Things get done more quickly. There's more innovation. Decisions are more durable. And people are happier. if they're dealing in a high trust environment. And fundamentally, as a leader, you can either deal with power, which is typically driven by fear or greed. You control promotions, you control who gets what bonuses, or you can deal with people through trust, through saying, I'm a fiduciary for you. I'm going to help you achieve your career goals. The former is actually quite effective. People will do things. If you put a gun to their heads, they'll do stuff.
Right.
So it works until it doesn't. And then when it doesn't, there's blowback. And if you're ever in a turnaround and you don't have high trust with your customers, with your suppliers, with your employees, with your creditors, you will not be able to turn around a company. And that's really kind of where the rubber meets the road, is when you have to do hard things. So to me, trust is this really precious commodity.
We'll be back to our interview with Joel Peterson in just a second. If you've got a financial question, don't forget you can email us anytime. Our email address is askjill@jillonmoney.com. We'll be right back.
Follow Jill on Twitter and Instagram for more personal finance content. Just use the handle @JillOnMoney. Now, back to the show.
You're back. It's Jill on Money, and we are talking to our guest, Joel Peterson. Now, Joel is the chairman of JetBlue Airways. But you know what? He also is a founding partner of Peterson Partners. It's an investment management firm. He's also on the faculty of Stanford University. Anyway, he's got tons of careers. And what makes this really interesting is that he's actually had a lot of experience talking to businesses in transition. So here is the rest of our interview with Joel Peterson. We're talking about transparency and trust. I'm listening to you talk about it, and I'm thinking some of the leaders that I know or I've met or interviewed, they say that they want to be completely transparent. But in practice, I think the hard part of it is it requires a certain amount of honesty, and sometimes being honest is hard. So you come into my office and you say, gee, I want this, 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 and this. And I say, oh, well, Joel, you know what? We're going to really try. But really what I should be saying is, Joel, you're not on that track.
Right.
I'm so sorry, but that's not where we see you in this organization. So sometimes I don't even think it's as nefarious as I'm lying to you. It's that I have a hard time really delivering that news to you.
The reason you have a hard time doing it is because you want to be loved.
Right.
You're solving to be loved.
Right.
And you should be solving for being respected.
Right.
And if you're solving to be respected, you'll say, we'd have to make these changes for that to be real. And it gets so much easier when you say, I'm going to be transparent and honest and people can rely on me. I deliver on what I say. You may not always like me, but people really hold on to this hope that they'll always be loved, that people will always understand there was a reason I did that and I'm forgiven for that. Whereas I think you have to develop a really thick skin. It's not hard when you say, I'm really doing what's best for the enterprise. Overall, I'm doing what's best for the greatest number of people, and I'll take some hits.
So how can managers and leaders get more comfortable with not being liked? What's your advice about the respect aspect of this?
I think if you show respect to others, and if you are transparent and you tell the truth is a really powerful thing. And over time, it will always out. So I think if you do that and people can rely on you to say, I know that when Jill tells me something, that's what's going to happen. If
you've lost trust, how can you regain it? So let's bring the clock back. It's 2009, the financial crisis. The banks, it sort of took us to the edge. No one goes to jail. There's not big prosecutions, but, they've gotten their butts handed to them. Right. Okay. Right. If you were coming in as a private equity investor or even just a a consigliere to somebody. Lloyd Blankfein calls you up and says, I love you. What should I do? What would be your advice if you've lost trust?
Stop saying we're doing God's work.
I love Lloyd, but I mean, really, that was bad.
That was terrible.
It was terrible.
I mean, you've got to reestablish a covenant with people that you are going to do the right thing, which may mean taking some losses. It may mean eating some crow. It may mean doing, but you've got to pay that price. I mean, that's the first thing that you've got to do. And then you've got to behave in a way that is trustworthy going forward. And I think you have to expect that it's going to take some time to rebuild that. You can't be afraid to say you're sorry and that you made a mistake. Rebuilding trust is a very hard thing to do. And if you trust, you will be betrayed. So you have to know how to fix those betrayals, how to move on, how to move away from them and recover.
Tell me more about the idea of what's going on at a place like JetBlue. What is it that keeps you hooked into this company that you really love so much?
So we had the chance to build a culture from the ground floor, which is one of the great things about starting a business, is you can build it the way that you want to build it. But then we have JetBlue University in Orlando, and we bring people in and they stay a lot longer there in training, and we train them as hospitality people, not just as flight attendants, but really as hospitality. And we select for really nice people, thoughtful people everywhere throughout the organization.
How do you select for nice?
You interview, you do reference checks, and that's one of the characteristics. In a lot of organizations, you're selecting for something else. I think if you select for nice, fundamentally changes the culture. You have a culture then that is a nicer culture.
Give me something bad that happens at JetBlue and how that nice culture supports it.
So I was tempted to tell you the story of the meltdown on Valentine's Day 2007 when we stranded people on the tarmac for 8 and 9 hours.
Oh, yes, do tell.
JetBlue doesn't want me to talk about that anymore because it's so far back in our history that we've kind of buried it. But I actually look back on that and think we recovered nicely from that. We alienated all kinds of people, and we did our voluntary Bill of Rights for customers. We didn't wait for Congress to come in and do that. David Neeleman, who was our founder, got on TV. He went on the Letterman show. He went on Bill O'Reilly. He talked to everybody and basically did a mea culpa, fell on his sword. I remember pulling David aside and said, David, you're way too apologetic for this. Everybody had the same problem. Don't do that. Mm-hmm. But he really felt emotionally bad. I actually think the answer to your question is, how do senior people who are under pressure behave? When the bullets are flying, how do they behave? Mm-hmm. And it's a really telling message to the rest of the organization. If they're losing it and throwing things and cursing and stomping around, that pretty much gives everyone permission to misbehave. If they're calm, talking about it, analyzing it, being thoughtful, that's the organization that develops.
Where would you start the process of being someone who walked in and into a company that seems to be a little bit in crisis?
I would ask to come to a board meeting and sit in on how they're doing that. I would ask to listen, maybe even follow around the CEO for a day. I'd ask to meet with everybody in the C-suite and listen to them, and I'd just observe. First of all, you have to diagnose before you can recommend.
Right.
Figure out what's really going on.
What role does corporate governance play? Because so many of these big tech companies have structures which kind of endow the founder or the CEO with special voting rights. It's like, how do you hold that person accountable under those structures?
Well, you're talking about Facebook there, and I think it's really tough. I mean, it gives way too much power. You have to superimpose good governance principles over that. And if you give too many rights to a Mark Zuckerberg or anybody else, they'll abuse them. There's that old line by Lord Acton, power corrupts and absolute power corrupts absolutely. And I think that really happens. I think that could happen to anybody.
What role is diversity playing in a lot of these organizations now? You happen to be sitting in a studio with a woman.
Yeah.
I know that's shocking to you. This is breaking news, right?
I teach at Stanford, so it's hardly shocking.
Right, exactly. Yeah. So how important is diversity, and how can we get companies to not just give lip service to it, to live it? Like, it's like saying trust. You have to live it. How do we live this?
So they have to see the benefits of it, really. I mean, they have to understand that this is a good thing. And the example I always give is of an orchestra. where if you had all bassoons, it would be miserable to listen to it. Without a diversity of instruments, timbres and all the things that you get in different instruments, it would be a terrible outcome. People need to understand that. The element that they also need to understand is that if they're all playing different pieces of music, that's even worse. So diversity for diversity's sake doesn't work. And so I think making that distinction to say we're not just going to have diversity, we're going to have diversity of points of view, every kind of diversity. We really want to tap in to the marketplace so we can learn. It's a little bit like in the book I talk about conflict.
Yeah.
You want to have conflict.
But healthy conflict.
Respectful conflict. In fact, I'll sometimes assign somebody to take the other side. Say, come prepared to argue against what it is we're recommending. And make your case. Make a great case. And they get a pat on the back for making a really compelling case. Because you want to know that.
Thanks so much to Joel Peterson. We are so happy he stopped by. The book is called The 10 Laws of Trust. If you've got a financial question we want to hear from you, maybe you just go onto the website, JillOnMoney.com. There you'll see a contact button. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
Welcome back. It's Jill on Money, and we do love to take the mystery out of your finances, but the only way we can really do that for you specifically is for you to send us a note. Our email address is askjill@jillonmoney.com. askjill@jillonmoney.com. Mark has set up the email so that you immediately get a response, which says, be patient, because we get hundreds and hundreds and hundreds of emails every week. Sometimes I would say bordering. What's the biggest that our inbox has ever been, Mark, before we started plowing through it? Did we ever get to 1,000? Because we do try to keep it trimmed. I think we did come close to 1,000 once, and then I stopped looking, and I told Mark to just send them to me. So we really do our best. Be patient. And Mark does the nicest thing ever that you can imagine when it comes to your emails. So if you send us an email and we answer it, you will be delighted by what Mark does for you. Okay? How about that for a tease? Good, right, Mark? You give me a thumb up. Thumbs up. Aren't I nicer this week than last week? See, I got a good night's sleep, good weekend of sleep. It's all happening. Nancy wants to know what we think about structured notes. Are they a smart investment or not? All right, so structured note, it's basically like the fixed income portion of your portfolio, right? So usually for most people, what they would do is they would buy bonds or a bond fund. And it's kind of interesting because it's linked to basically a structured note of basically linked to something that's underneath. It's some sort of debt obligation, like an IOU, and it can be usually from a bank, and it invests in lots of different types of fixed income products, but also with usually some sort of component that juices the income to you, meaning that they usually use some leverage. So here's the deal. Nancy, I can't say it's good or not for you. It's like saying, do I think commodities are good or bad? It depends what portion of your portfolio is invested in a structured note. It also depends on what's going on in your life. One thing I worry about with structured notes and really any fixed income investment that is performing better than sort of your plain vanilla opportunities is that there's risk. And so if you're going to do anything like this, you've got to remember that because there's risk in everything, when you're getting a higher interest rate than, say, your boring old corporate bonds that are investment grade, you're taking risk to do so. So maybe that's credit quality, maybe that's leverage, but there's risk. So let's just remember that. Okay, Bobby writes that her husband recently passed away at the age of 55. Oh, no. She's also 55. They've got 2 adult children living on their own. And she writes, is it true that I will not get any of his Social Security money? He's been working since he was 16 years old, and I've been working as a teacher for 33 years. Mark, that seems, don't you get a benefit when somebody dies? I don't think that that's true at all. So here's what I would do, Bobby. I would talk to Social Security. You can call them. You can walk into an office. But you should get survivor benefits. And so I don't think that that's true. We'll need to get you more information, but you should be entitled to something. Wesley writes that he's going to retire this spring. Wow. He'll be 66 years old. He'll have Social Security monthly income of $2,300 if he claims it. But if he waits till age 70, Social Security will go from $2,300 a month to $3,100 a month. So should I wait? I figured that if I take Social Security at 66, basically he's done the math. The math usually goes like this, guys. You got to live a certain amount of time to make it worth it. So if you wait until you're 70, you generally have to live until you're 83-ish before you break even. So if you're in good health, it sometimes really can make a lot of sense to wait. Also, if you got a dependent who is claiming on your record, it may also be very helpful to wait. But anyway, to go on with Wesley's situation, he's got $800,000 in a traditional IRA, and he says, ready for this, guys? It's mostly invested. That IRA is invested in blue chip stocks. Are there investments to protect assets and generate income in retirement? Would you suggest annuities? No, I would not suggest annuities, unless you can get a really low-cost one. But let's get back to your first question, which is, should you wait? I mean, if you are, as you say, that you're going to retire and, you've got, generally speaking, some decent income and you don't have to claim, then sure, that would be great. But it really has to do with what your situation is. So here's what I would suggest. I think you should follow up with us, Wesley, and tell us whether you could wait. Is there other money outside of this IRA that you could do, that you could use to float that? It's a real question. Is there anyone else claiming on your record? There's so many different permutations of what's going on. I need more info. All right. What I do know is, generally speaking, I think that you should be wary of annuities unless you're getting one of these low-cost ones, which are hard to get. Okay, last one for this segment. Keith writes, a few shows ago you mentioned that figuring out retirement income, you could generalize that every million you had could generate about $35,000 a year. I'd never heard that bromide before. I have a few questions about it. How do you arrive at that? How would that money be invested to achieve it? I've got $3 million. I want to retire in a year at age 58 or 59. My wife is 60. We'll have about $50,000 in pension income plus Social Security. Okay, so this is a rough calculation. It's based on a safe withdrawal rate that presumes that you don't want to run out of money. So it factors in sort of the up markets, the down markets. It's generally a balanced portfolio, maybe as much as 60% in stocks and 40% in fixed income, but not 70-30. And whether you could actually, on your $3 million, in addition to your pension, make it or not, that's a kind of a very personal decision. But that's about how we get that $35,000 a year, and it's not inflation adjusted. And many people think we should really be counting closer to $30,000 because interest rates are so low. But anyway, good luck, Keith. I hope that helps. Follow up with us if you got more questions. You're listening to Jill on Money, and if you've got a financial question, we'd love to hear from you. Maybe during the break, go to the website, jillonmoney.com, and up there in the top right-hand corner, there's a neat little button. It says Contact. Click on that, and you can absolutely get in touch with us. Don't forget, while you're on the website, sign up for our free weekly newsletter.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money, and we are delighted that you are hanging out with us this weekend. If you miss any of this show, or you'd like to go back and listen to previous shows, or maybe you want to go and check out our podcast, which is very conveniently named Jill on Money, all you have to do is go to our website. Go to jillonmoney.com. Mark, somebody just in the business said to me, "Oh, you're such dopes. Why aren't you monetizing your website? You should be selling ads on your website." You think we should do that or not? I don't feel like I'm in the ad business like that. I feel like I do what I do. It's great. I love this show. It's awesome. We have so much fun doing it. Mark and I really have developed an approach to this that puts you right in the middle of it. So, bad enough I got to hawk my weekly free newsletter or my book, which I'll do in a second. But I don't know if I want to. I don't know. I don't want to put ads on it. It's so nice and clean. Mark, you and the Mad Russian did such a beautiful job on that website. So good. Anyway, check it out. JillOnMoney.com, ad-free website. And, check it out, okay? If you've got a financial question, we want to hear from you. Just send us an email. Or if you are on the website, just click on the contact button in the upper right-hand corner. Jose writes this. Dear Ms. Schlesinger, which usually means that this is somebody very young, because otherwise who would say Ms. Schlesinger? Mrs. Schlesinger, that's my mother. Ms. Schlesinger, just call me Jill. Here's the question. I'd like to know what you would charge me to answer a financial question. How about this? 0. I'm going to answer it right now. Okay, so Jose invested $40,000 in a 2.25% 5-year CD 2 years ago. My question is, would it be wise to withdraw those funds and invest them in my stock portfolio? I didn't have a stock portfolio at the time I bought the CD, and I understand I'll be penalized. I'm just wondering, is it wise to make this move? No! First of all, what a hero you are. 2.25% 5-year CD. You're not getting that anywhere. This is a perfect example of how you put the money aside. It's growing. Let it go. If you want to keep investing in stock or stock mutual funds, that's fine. It's great for you to have a nice, solid CD, and do not get it out. And the fact that you're even asking this question leads me to potentially believe that perhaps you may just want to stick to your own, your old system. Don't go back. Just do what you're going to do. Okay? How's that? Isn't that good? Fantastic. All right, Mark, here comes the inevitable question. Ready? Bonnie says, my husband and I are almost 50, and we want to protect our money that is in mutual funds, both retirement and non-retirement. But we're afraid of an inevitable market correction. What's the best thing to do with our money to protect what we built? This is like the inverse of Jose's question, which is Jose's like, oh my God, the stock market's making new highs. I want to dump my CD and pop it into the market, right? Chasing the market higher. And Bonnie and her husband, who are 50, they want to do the opposite. They're like, I'm so scared. New highs. Now what? So here's the deal, guys. Something in between is going to work. Bonnie, in her case, she's 50 years old. She's going to live 30, 40 more years. So let's not try to time the market. That is an entire chapter of my book. That is dumb thing number 13. You try to time the market. It doesn't work. Hey, guys, I tried to time the market. I write about it in the book. So if you want to find out why this really doesn't work, all you have to do is buy the book. See how I kind of wove that in, Mark, into the whole flow of the conversation? Seamless is amazing. The dumb things smart people do with their money, 13 ways to right your financial wrongs. Bonnie, no. What you can do is make sure that you have a portfolio that is diversified. So a diversified portfolio means some stocks, some bonds, maybe even some international stocks. But you really want to be clear that if you can make yourself adhere to that diversified portfolio, you will not second guess yourself. So if you had 100% in stocks, I'd say, okay, let's do it. And if you have a 50-50 portfolio, you probably don't need to do anything. But if you're really wondering what your allocation should be, we'd love to hear more from you, Bonnie. That's clear. Okay. Here's a question from Bruce. It says, what's the best way to invest in 5G? I'm sure that there's some specific companies that provide the technology to the big telecoms, but it's really the telecom companies that are going to do this. You probably have heard that Sprint and T-Mobile's merger basically got approved. We now have, instead of 4 telecoms, we have 3. A lot of people went bananas about that. Don't be bananas. I think Sprint was going broke anyway, so it probably wouldn't have mattered. But I'm not an expert in this. I just put money in index funds, and there's something in that index that probably is going to get you there. Okay, last one before we finish this out here. Here's Susan, who's got a 26-year-old son. He's single, and 26 years old, he makes $90,000 a year. He's got no deductions. He's got a Roth 401k. Should he switch to a traditional 401k now that he makes more money, or does it not really matter? Thanks for your great advice. Susan, let's have him continue to use that Roth 401k. Let's have him pay taxes at these bargain basement rates so that he is not going to have to worry about having money that has to come out of his portfolio later in life that hasn't yet been taxed. I say keep up with the Roth. Thanks for writing. Okay, it's Jill on Money. During the break, go on, JillOnMoney.com. Check out our resource section. We'd love to hear from you. If you stumble across great financial resources online, send them to us. Do it. And then we can add it to our resource section as well. Okay, we'll be right back. You're back. It's Jill on Money, and we're broadcasting from the Policy Genius studios. Policy Genius is the easy way to compare and buy insurance. Just go to policygenius.com. Don't make the mistake that my 20-something-year-old nephew made. He didn't have renter's insurance. You can go onto policygenius.com, make a few clicks, and then have renter's insurance. Boy. All right. Before we finish up the show, let's get to some of your email questions. Brenda writes, what are your thoughts about a variable annuity? I've got a 401k and a retirement fund and money in stocks and bonds, approximately $220,000. My financial advisor wants me to take money from my stocks and bonds, put it into a variable annuity, so I will not lose what I have gained and also will be able to have a determined income in my later years. I'm 65. I'm still working, not collecting Social Security until 66. I will have to work until at least 72 to stay afloat. Absolutely not. Mark, I feel like we need the klaxon again. I mean, we got to just have the buzzer ready for these annuity questions. First of all, why would you drain the liquidity from your life and pop it into an annuity? I'm guessing that your financial advisor is not suggesting that you are going to buy a low-cost annuity. If you really are going to keep working and you're going to keep putting money away, I think that you want to have a lot of options. I do not believe this person is a fiduciary, probably not putting the you first and not putting your best interest first. So number one is I'd probably find another advisor. Number two, no, you should not be doing this. And let's do this before we close up. Pauline says her mother and grandmother are on a CD which matured recently. My uncle, who's the executor for grandma, wants me to sign off so he can get half the money. What? My uncle has a 6-unit apartment in the Bronx, New York that he got from grandma. He wants mom to sign off so he can access the money. Help. I'll give you help. Go get a lawyer because uncle seems like not to be trusted. So you need to go talk to an estate attorney and make sure that that is a qualified New York estate attorney, okay? Oh, boy. A lot of bad actors out there. Mostly good, but some bad, too. All right. It's Jill on Money. Thank you guys so much for listening. If you have a question throughout the week, just send us an email, askjill@jillonmoney.com. And hop onto the website at any time, JillOnMoney.com. You can contact us from there as well. Okay, have a great week. We'll talk to you next weekend.